Good morning, everyone. Well, the main event on the schedule for today is the release of the minutes from the recent FOMC meeting. We got a hint yesterday of what those minutes may contain when New York Fed President William Dudley gave a speech in which he discussed how the Fed was likely to exit its extraordinary measures. He also noted that the FOMC takes into account the reaction of the markets in determining its actions. If the response of the markets is mild, then he said, quote, this might encourage a somewhat faster pace of tightening rates. But he noted that, quote, if bond yields were to move sharply higher, as was the case last spring, then a more cautious approach might be warranted. Dudley may have been rehashing some of what he and his colleagues on the FOMC were discussing. If so, then it should be bearish for U.S. bonds and bullish for the dollar when the minutes are released later today. Since the much better than expected April non-farm payrolls figures were released on the 2nd of May, Fed funds rate expectations have actually declined by 22 basis points at the long end, while 5-year yields are down 15 basis points and 10-year yields down 10 basis points. In other words, the response of the market hasn't been just mild, it's been enthusiastic. This would argue in favor of a faster than expected tightening and should be supportive of the dollar. Well, we'll see if any of this comes out in the minutes later today or in FOMC Chair Yellen's address to the graduation ceremony of New York University. Now, the most important point to note about the markets, though, is that even with U.S. interest rates falling, the dollar is well supported. It gained yesterday against most G10 currencies and almost all the emerging market currencies that we track. Apparently, there's some risk aversion coming in the market now. Perhaps as a result of fears about the European parliamentary elections and the rebound in peripheral European bond yields. Perhaps due to the military intervention in Thailand causing an outflow from emerging markets. But anyway, the point to note is that this time around, the risk aversion is rebounding to the benefit of the dollar. That means investors with EM carry trades on should consider making the euro their funding currency, or at least should not have the dollar as their funding currency. During the European day, the main point of interest will be the UK retail sales figures for April. These are expected to show a rebound in sales, both including and excluding autos. That ought to be good news for the pound, as it would confirm that the consumer-led recovery in the UK continues. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, Global Head of FX Strategy at IronFX Global, wishing you solid trading.